family of securities and broker dealers, and he wanted to return to his first passion, which was the financial markets, after spending time in what is a tough industry. I think I would agree the entertainment industry is tough. Brad has spent a number of years studying technical analysis in depth, especially in the areas of trend development and recognition, and actively trades the futures and the ETFs on an intraday basis, as well as swing trading ETFs and equities. Now, Brad has been a presenter for us before, and gives a terrific presentation. So with that, Brad, I'm going to turn the floor and the podium over to you, and look forward to a
Hey, Raleigh,
presentation.
can you hear me okay?
I can hear you just fine.
Can you hear me okay? Okay, everybody can hear me okay? I have a new headset, so a relatively new headset. So I will need to launch the application.
Of sorts for the headset?
No, I've done a couple of webinars with it, but I think this is the first one in Omnovia.
All right. No, we can hear you loud and clear, buddy.
The projector's loading. Monitor 2. Are you seeing my picture okay?
Yes, we do. We do see your picture. We hear you. We have liftoff.
Okay. All right. I'm good to go. Hi, everybody. I'm Brad Powell from Right Angle Trading. It's a real pleasure to be back with the TradingPub. I want to thank Cam and Raleigh and Morgan, of course, and Yana, and anybody else at the TradingPub that I may have forgotten. Thank you for having me back. And I will just forewarn you, I am one of the world's largest San Antonio Spurs fans. I went to college in San Antonio. I grew up in Dallas and followed them since they were the old ABA. Unfortunately, I'm really dating myself here. ABA, the Dallas Chaparrals. So I am a diehard Spurs fan who lives in Los Angeles, which is a hard thing to do. So you may periodically hear my son running into the room and yelling at me, "Spurs up by 5," or "Spurs," you know. So please don't be. Yeah, Cam says, "Go Spurs!" Yeah, baby, we're all over it. Somebody's saying, John Coley, no sound here. I assume everybody else hears me okay. Hopefully I didn't jerk my headset out. Everybody else does, so that's John's problem. All right, so what we're going to talk about today is the ETFs. I'll just give you a brief background on myself. I grew up, started trading stocks when I was about 12, but I kind of drifted into the entertainment industry, worked in sales and marketing in the entertainment industry for many years. And was always kind of trading on the side, and of course with the advent of electronic trading, it really allowed me to make my living doing that. So soon after the year 2000, Y2K, I quit the entertainment industry and have been trading full-time ever since. And around 2008, I had hooked up with Beck Crow, who founded Right Angle Trading, and she was very much into technical analysis, one of the founders with Horst Mueller of the Canadian Technical Analyst Society, and liked what she was working on because we both worked with Divergence. So I joined Right Angle Trading. She had formed the company in 2002, and right at that time was when leveraged ETFs became available, when the SEC approved active management of ETFs, allowing higher leverage as opposed to just tracking stocks. And I think we recognized, and Bet, to her credit, really recognized the growth that we'd see in the ETF market. So I'm specifically going to talk about ETFs and risk management for leveraged ETFs, because they're a very different beast than just trading the SPY and some of those things. Raleigh, are you telling me to hit the blue X in the upper right-hand corner?
No, I'm sorry there, Brad. There's some folks that had some problem with hearing the sound, and if they hit the blue X up there, that resets their screen. So.
Okay. I didn't know if you were telling me to do it to reset something, or okay. So I'll move on. So when we're talking about ETFs, and I'm specifically talking about leveraged ETFs, your risk management starts before you ever place the trade. And risk management is really critical. You know, for those of you, if anybody's been here for this all-day thing, you've probably learned more about trading than you ever thought you'd know today. So we're going to talk about just specifically risk management in this presentation. It can be applied to other markets, but leveraged ETFs are really kind of their own beast. And risk management doesn't necessarily mean you know, I'm going to place a $2 stop when I jump into this trade, because you can't do that with leveraged ETFs. And it starts before you ever place the trade. And where it first starts is with the leverage you select for the trade. So when you look at any given market, and you know, there's over 1,400 ETFs and ETNs available on the market today. The difference between an ETF and an ETF uses equity to gain leverage, and ETN uses secured debt, bonds, to gain leverage. Virtually any commodity, any currency that you want to trade. You know, John, that's actually a big part of this presentation, is we'll talk in a minute about deterioration, and that can work both ways, and I'll get heavily into that. And why we use, and I'm going to show you guys some specific tools that we use for leveraged ETFs that we use in place of more traditional tools like price pivots, because they don't work, or Fibonacci retracement, they don't work on leveraged ETFs, and I'll get into why in a little bit. So most markets offer an unleveraged ETF that is going to track the underlying index sector commodity perfectly to the penny. The SPY, you know, if the S&P goes up 1% in a day, the SPY goes up exactly 1% to the penny. The market makers control that so that it's perfectly tracking the index. It is a tracking stock. That's what it's there for. Leveraged ETFs are not necessarily designed to perfectly track the underlying index, and we'll get into that in a minute. Most markets offer a double leveraged ETF that anytime you read what an ETF is, it states, its profile, it's going to state it seeks to return twice the daily investment return that corresponds to the underlying index sector, commodity, etc. Twice the daily investment return. It doesn't say weekly, it doesn't say monthly, it doesn't say annual, it says daily. So on any given day, it's going to attempt to return 2 times what the underlying index does, or in the case of a triple leveraged ETF, 3 times the underlying index. Most markets also offer an inverse ETF, unleveraged and double leveraged, which means when the market goes up, it's going to go down. When the market goes down, the inverse ETF is going to go up. It's a bear ETF, short ETF. You can think of it that way. The advantage to it is it allows you to go long a commodity, or I'm sorry, not a commodity, a equity, an ETF, the same way you'd go long a stock in something like an IRA or another account, type of retirement account that normally would not allow short selling. So it gives you that short exposure. Some markets offer triple leveraged ETF and a triple leveraged inverse ETF. And then there are a few extreme ETFs. They haven't been very successful. I think as the years go by, you know, 4 years ago, ETFs represented about 15% of daily market volume. Right now, they represent 45% of daily market volume. That's a staggering figure. 45% of daily market volume is in ETFs. Now, a lot of that is in tracking stocks like the SPY, the Qs for the NASDAQ 100, the DIA for the Dow, the IWM for the Russell 2000. But when there's 1,400 ETF products out there, you know, they're going to account for a huge amount of the daily volume. So some markets, in addition to the triple leveraged, the RTSA for the Russell 2000 was an example of these ultra leveraged. It was about 6 times the leverage. It was an inverse bear ETF, and it got wiped out. So they canceled it. It was Barclays had issued it, and they ended up doing away with it after about 6 months, as the Russell 2000 went up at 6 times leverage, went from $100 to 0 very, very quickly. But I think we'll see some more experiments with those types of more highly leveraged ETFs in the future. But so the first decision you have to make is, what leverage are you comfortable trading? Obviously, if you're used to setting a 2 or 3% stop on something like the SPY, now you're going to have to look at a 9% stop or an 8%, you know, 6% stop, whatever the corresponding stop is on triple leverage. So you need to make the assessment within what type of risk you're comfortable with before you decide which ETFs you're going to trade. The other thing you have to consider is the volatility of the market, because some markets are very stable, they price very well to the underlying index, and others run away because of supply or demand, or are just an inherently more volatile market. And let's look at some examples. First, let's look at an example of a highly volatile market versus a slightly more stable market. So let's say you decide, I want to get into trading commodities. I'm going to look at silver and gold. Which one am I going to trade? Well, what I like to do is I just put up a percentage basis chart and compare them. So you can put up a percentage chart and compare. And if you look in this move, and what we're looking at is the GLD, which will track the price of gold perfectly in red, and we're looking at the SLV, which is the tracking stock for silver, will track the price of silver perfectly. These are not leveraged ETFs. These are unleveraged ETFs. And let's just get an idea of how volatile these markets are. So here to the left of my screen, following my tracker, you can see a move in gold that went up about 10%, went from down 25% to almost down 15%. So actually about an 8% up move. And during that same period of time, silver went from -40 to almost -25. So we're looking at closer to 17 or 18% move in the price of silver. When they came back down, gold went down 10%, whereas silver went back down, 15 to 18%. And then the next move up, they actually tracked pretty close. But you can see just by throwing it up very quickly in 2 minutes, throwing up a percentage-based chart compared to gold and silver. If you wanted to start trading precious metals, but you had a low appetite for risk, you're better off trading gold than you are trading silver, because the silver market is inherently more volatile. When you move into double leverage, that becomes magnified and amplified. So the AGQ, which is the double leverage bull ETF silver, is not necessarily, and we'll look at some examples of this in a sec, is not necessarily going to make, okay, so this moved up 17%, a 34% move. It might make a 40 or 45% move because of open supply and demand in the market, and because of the derivatives they're using for leverage. Conversely, if you're on the wrong side of the trade, it's going to go against you more than what you expect it will. And we'll look at specific examples of that in a moment when we take into account decay. Now, let's compare that to probably the most stable market out there, which is the SPY, which is in green, and compare it just to the Russell 2000 in red. We all know the Russell 2000 is an inherently more volatile market. You can see that they track very well going up, but the IWM overshoots a little. They come back down to the same level, going back up. The IWM, again, these are unleveraged, so we're just trying to get a sense of what the market is, the market themselves are doing. It comes back down a lot more, not near as much stability as we see in the SPY, and then it runs away when it goes back up. So you get a much higher return. You also have higher risk when you enter any of the ETFs in the Russell 2000 than you would the S&P 500. When you're going into triple leverage, the TNA-TZA pair for the Russell 2000, or the UPRO SPXU pair, that's the bull and bear ETF at triple leverage for the S&P 500, this is going to be the difference between the two markets. The increase in volatility that the Russell 2000 has is actually going to be amplified. So the second level, you have to decide what leverage you're comfortable trading, and then make a decision on what markets you want to trade based on the volatility of the underlying market. Certain markets are always going to be more stable than other markets. The third thing you need to look at is the potential for overnight gaps, because when you're getting into leveraged ETFs, there's a huge potential for an overnight gap. And to show you that type of potential, this isn't even a leveraged ETF. This is an unleveraged ETF, the FXI, which is the large cap index for the Hong Kong index, the China 25. So it's the equivalent of our Dow Jones Industrial Average. So you decide you want to trade the FXI, swing trade it, and you're going to hold it overnight. You have to take in consideration that market is trading while the rest of us are asleep. The Hong Kong market is open overnight while the U.S. equity markets are closed. So first thing in the morning, if it's had a 300-point move overnight, that's going to be priced into its ETF at our open, the FXI trading on a U.S. equity exchange. And you can see in an unleveraged ETF, gaps as large as 3% to 4%, and then very little price movement intraday. So if you're looking at a longer term investment and you're not really concerned with what the FXI is going to do on a daily basis, what the gaps might be, great, a wonderful way to invest. But as a trader, I don't want to trade anything that's going to gap this much, especially when you get into the leveraged ETFs for that market, because now you're looking at potentially 10 to 12% overnight gaps. If you have a 6% stop on a leveraged ETF, it could bypass your stop, and you know I could get double whack there. Instead of taking a 6% loss, I could take a 12% loss. So that immediately rules out a lot of the overseas markets for me as a short-term swing trader, and by short-term I mean 2-day to 2-week primarily is the duration of trades that I'm going to be in. You know, when I see that kind of gap in the chart and then very little intraday price movement, because most of the move is going to be priced in the overnight gap, then it's something I'm not interested in. We do at Right Angle Trading, we trade the emerging markets, which is more of a basket of overseas markets. We trade the triple leveraged ETFs on it. You can see it still is prone to large gaps, but not as large as the FXI, because some of the major components of the emerging markets, of the MSCI Emerging Markets Fund, which is the EDC, EDZ pair, bull bear ETFs, are in South America, and so their markets are open at the same time as our markets. The largest single holding is Samsung, which is trading on the Korean markets, but also trades on US markets. So there's still quite a bit of intraday price movement, but you still have to be aware of the gaps. If this is something you're interested in trading, the EDC, EDZ pair, triple leverage ETFs for the emerging markets, I'll tell you we have a rule of thumb for it. If the opening gap in the EDC is greater than 4% on any given day, I'm probably going to leave it alone. I'm not going to take a trade signal into it because it's leaving a little too much of a gap. I may get a signal to go long the EDC, go bullish on a gap like this, but you know it's leaving too much of a gap in there for me. If it's 2%, 1%, you know, more of a trading gap, I don't really worry so much about it. And also if it moves more than 7 to 8% on a day, because it will run 10 to 12% on a day, and I get a trade signal, I kind of leave it alone because it's going to back up generally and return some of that. And you can see how if you had a signal to go long here and it gapped down and really collapsed the next day, that's a huge percentage gap down from there to there. That's about a 5% gap. So on certain days where it surpasses a maximum percentage move, I think it's a good market to leave alone. But it's also a very good market to trade, and we've actively traded it over the years and done very well with it. Something else you should take into consideration is the liquidity of the ETF. I'm going to look at this chart's about a year old. This is the DBA. Most of the charts I'm going to show you are very recent. This one's actually older because I just like showing the flat line in the DBA as we get into the end of summer, and then as we get into the spring, the huge moves. This is a double leveraged agriculture ETF, and it's seasonal. And look at the change in the volume. Where back here, there's days where it only trades 100 or 200,000 shares, as low as 105,000 shares on a day. And then it jumps up in the spring as crop reports are coming out, weather reports over how much spring rain there's going to be. You know, it jumps up to 3.5 million in a day. So you may think, oh, I want to start trading agriculture and I'm going to use the DBA. And then you hit the late summer and fall months and winter months and realize it doesn't really move. And it has no volume. And then all of a sudden one day it does, and for a couple of months it's hot, and then it goes away again. Well, you need to know the seasonal patterns of an ETF if you're getting away from the major indexes. This is especially true of commodity ETFs. Any of the agriculture ETFs, oil ETF kind of is seasonal. Silver ETF can be very seasonal based on when all of the Canadian mines are reopening at the end of winter, that type of thing. Learn about the market you're going to trade. Just because it's there, just because, you know, a palladium ETF is now available and, oh my gosh, I'm going to trade palladium, that sounds like fun. Study the market, look at it, you know, make sure it has consistent liquidity day in and day out. You know, you compare the agriculture to the SPY. I mean, even on even if on a bad day, the SPY is going to trade 50 million, so you can count on having the liquidity that you need. The same with the UPRO and SPXU, the triple leveraged ETFs. You can count on the liquidity you need. Sorry about that. Something crashed for a second. I should be back with picture now. Can you hear me okay now? Great. What about using options on leveraged ETFs to limit risk? Since you're asking the question now, Adam, let me answer that. If you're trading the UPRO or the SPXU, I could see selling covered calls on a position if you're bullish on it. The problem with the options on the leveraged ETFs are you're combining premium on top of leverage, and they tend to have wide spreads, not a lot of volume, and you can get kind of trapped in them. So we have clients who trade with us. Are you on one? And I'm back again. I don't know what's going on. Why this dumped for a minute. Hang on one sec. Hey, all right. Sorry about that. Okay, I'm back. So anyway, back to the options on leveraged ETFs. They can be very thin. They can have wide spreads. So what we recommend clients do is just use something like the SPY options, because the premium on the options that they gain or lose is kind of equal to the dollar amount on the triple leverage ETFs. We kind of recommend leaving the leveraged ETF options alone, just because they can literally be wiped out in a matter of hours during the day on a big move that may reverse and go back the other way, simply because they're so thin and the spreads go out. So you're better off with something like the SPY options, and then the premium inherent to options, kind of balances out the leverage if you're trading a triple leverage ETF. So back to the SPY chart, you can see, this is the kind of consistent volume we like to look for in ETFs. And you're not going to get this in leveraged ETFs, but the TNA, TZA trade on average 15 to 20 million per day in and day out. The UPRO SPXU trade 5 or 6 million a day in and day out. You compare, the SPY always trades great volume. So that's what we mean by, checking the liquidity of the ETF. You need to know how well an ETF tracks its underlying index, and I'm going to give you my rule of thumb. New ETFs come on the market every day. Every single day there's a new ETF product on the market. Until it trades for a year, I won't touch it. Until something is actively traded for a year and they have a year of data, I won't touch it. And anybody here who's seen my ETF presentations in the past, I always use this slide because I don't think we'll ever see such a classic example of this again, of an ETF that did such a horrible job for a number of years of tracking the underlying product. 30% rise in natural gas futures. This was a couple of years ago. And during that period of time, the UNG, the natural gas ETF that's supposed to track natural gas perfectly, went down 10%. Natural gas flatlined for 6 months, and the UNG just kept falling. The early days of the UNG, they were using options on futures to gain to try to track the price, and they were going so far out and paying so much premium that they could never get enough rise in the cost of natural gas to make up the premium in the options they had purchased. They were a year out, and their net asset value was plummeting while the price of natural gas was actually going up. I've seen it happen with the financial sector ETFs after they had been out for about 6 months. They both collapsed, the FAS, FAZ, which now they've rebalanced. They do an excellent job of tracking. But anytime a new highly leveraged ETF product comes out, it's like you and me as retail traders, we sit and we paper trade and, oh my God, I just made $1 million in the last month. You sit down and you do it live, and it's very different. Suddenly you see market conditions you haven't seen before. You have slippage. You have some extreme news event that wipes out a position. All of these different factors that come into play happen with the active management of the ETFs in the way that they're gaining leverage. So they can do it on paper all they want. Until they actually get in the market and do it live, you don't really know how well it's going to track. So my personal rule of thumb is until an ETF trades for a year and I have a year of data on it, to see how well it tracks the underlying market, to see what kind of gaps it has, see what its performance is, I won't touch it as a trader because I don't want to get in something and see something like this happen and be scratching my head every day saying, geez, I want long, natural gas has been flying, but the ETF for it isn't doing anything. I'm losing money on it. I don't understand. Well, it's because these are actively managed by someone else at the company that issues the ETF. And for the most part now, they do an excellent job of tracking. The UNG now tracks perfectly because they revamped it, but it's just something that you need to be aware of before you ever trade a leveraged ETF, especially a highly leveraged ETF, because you may not get what you're expecting to out of the trade. Now I want to talk about, somebody asked the question early, time in trade versus derivative decay. And this is something you need to be aware of. So I'm going to give you some very simple rules of thumb for derivative decay in leveraged ETFs. If the trade goes in your direction, in the short term, the leverage is actually going to work in your favor in the short term most of the time. And I'll show you an example of that, a specific example on an actual trade in just a second. If the trade goes in your direction, leverage is going to actually work against you in the longer term. What I mean by that is if you're going in for a year and you expect the SPY to go up 10% and you think, well, I'm going to take 30% gain on the UPRO, you'll never get it. Almost all of the time, and the reason I say almost all of the time is because I would say all of the time, absolute, but nothing is ever all of the time in the market, as we all know. But almost all of the time, you can bet on it. If the trade goes against you, leverage is going to work against you in the short term. If the trade goes against you, leverage will definitely work against you in the long term. That means that you have the potential for a larger loss than what you expect. So let's look at specific examples of this. A 2-week short-term move. And we happen to be in a trade at this time and took advantage of this. The IWM from my first line to the second line went up 6%. So the triple leveraged ETF should return 18%. The TNA actually went up 20% in that same period of time. So why is that? Well, they're using options on all of the Russell 2000 stocks to gain leverage. As those stocks are going up, the premium on those options is going up a little bit faster than the market. Combine that with supply and demand in the open market and the fact that the TNA is not fixed to the underlying index the way the IWM is, the way a tracking stock is, so it can close up a little bit more every day. And I've seen much more extreme examples of this, but in the short term, that leverage is actually going to work in your favor. You'll get a couple of extra percentage points out of it, and I've seen much better examples than that. I'm sorry, this slide should read 2014 over here on the far right. But so let's talk about now specifically in the longer term how that leverage is not going to work in your favor. November 1st, 2013 to March 25th, 2014, the SPY went up 6.75%. 3X should return 20.25%. The UPRO actually returned 19.25%. 0.17%. So they cheated you out of a percent. Why is that? Well, it's gradual decay in the derivatives that are used to gain leverage are gradually going to work against you in the long term. If that trade goes the other way and goes against you, you're going to have much higher risk, however. And let's look at an example of that. January 3rd, 2014 and March 25th, 2014, the IWM, the tracking stock for the Russell 2000, went up 2.73%. So if you went into the TZA, the triple leveraged inverse bear ETF, thinking, the markets are overbought, they're going to go down for a while, I'm going to take a short position in an inverse ETF, you should have had an 8.19% loss. In reality, you had a 13.3% loss. The TZA went down 13.3% during that period of time, because now you're combining not only the market going against you, you're combining daily derivative decay, weekly derivative decay in what they're using to gain that triple leverage, and those premiums on those options are plummeting in the puts that they're buying on the Russell 2000 stocks. The premium is plummeting against them. So you're actually losing almost twice as much money, and you need to be aware of that in your risk management. Anytime a trade goes against you and you're in a triple leveraged ETF or a double leveraged ETF, it's going to go farther against you than you think, and it's important to be aware of that fact. Anyway, so all of those are factors that need to be taken into account before you ever enter the trade, right? So after you decide, this market looks, I'm comfortable with the volatility of this market. I like the triple leveraged ETF, or I like the double leveraged ETF. I know it has consistent liquidity. I know, it has some overnight gaps, but they're not horrible. Now you get into a trade. How are you going to manage the trade? And, I always tell people in webinars, the way I take a trade, the methodology I use, everything I do is divergence-based, looking for either market reversals or trend continuation trades. You may not be comfortable with that. Some people are buying support and resistance. We all have our different methodologies. They may not be right for everybody, but I'm going to show you some methods of risk management in these highly leveraged ETFs that work very well, and they've worked for years, and they work better than some of the other more traditional methods because of what I've shown you. So let's talk about this for a sec. Daily price pivots, Fibonacci retracement, those are based on percentage formulas. But when a trade goes against you, or you're in a trade for a while, or you're looking at that quick retracement, you're in a runner, it goes up, it goes up, it goes up, now it's going to retrace. If it's the SPY, the S&P 500, and you trade off Fibonacci, you may expect that, 66% Fib retracement, right? Not in a triple leveraged ETF. It is not going to come down, or that 34% retracement, it's not going to come back down 34%. The SPY might, but the UPRO, the triple leveraged ETF, isn't. It's going to come down 40 or 45%. You don't know. There's no formula to assess that. Does that make sense to everybody what I'm saying? Because of the decay in the leverage, there is no pat formula you can use to assess where the triple leveraged ETF is going to go. And there's no way to correlate it. You can't just say, well, I'm going to look at a SPY chart and trade the UPRO or the SSO off of the SPY chart, because there's no correlation that can ever be calculated of how that decay in leverage is going to work against it during a retracement, or how it's going to work during the run-up. You can't use a Fib extension because the premiums on the options used to gain leverage may soar. So you need to use, you can't do it on NAV calculation, because there is no NAV calculation for triple leveraged ETFs in reality. The SPY has a NAV calculation, but the UPRO doesn't. They have only on a daily basis do they have a net asset, an accurate net asset value calculation. Only at the end of the day, on that given day. You can't look at the net asset value over a longer period of time. Who are the market makers? The same who are the market makers for the SPY and anything else. They're traded. Most of them are traded on the Amex. The issuers kind of help control it. So the issuers that we like, Direxion has been around forever. any Direxion ETF is going to do a great job of tracking the underlying index. ProShares, these are the two biggies right now, ProShares and Direxion. They're ETFs. They were there in 2008 when the SEC approved active management of ETFs. They were the first to launch these ETFs. They've been there doing it for a long time, and you know, they've got the experience under their belts, and consistently you will see their ETFs track the underlying market better than any other issuers. There's 20 or 30 different issuers out there for leveraged ETFs, but Direxion and ProShares typically have the highest volume. They're the ones that people are most interested in because they know they're going to do the best job of tracking the underlying index. But something like the UPRO, when it's coming back into that 33% fib retracement, or it comes into that daily price pivot, that may be meaningless the next day, depending on what the market's doing and depending what set of options they're in to gain that leverage. So we like to look for more reactive ways to kind of figure out where a run's going to end and where we would expect a reasonable retracement to occur. So first, I just want to look at the chart and kind of look at, kind of assess, and I'm going to tell you what I have on here. In green, we're going to try to assess where can I find pivot points, what tool is going to help me recognize it in a, this is just a double leveraged, but I'll show examples in multiple leverage to see how well this works. So what I've done is in yellow, I've put on Bollinger Bands. In purple, I've got on a Keltner channel, and I'm going to give you the settings for it in a second because there are custom settings. It's not an out-of-the-box Keltner. And then I've got I do away with the midline of the Keltner. That's because it's just a 20-period simple moving average. And I have a 20-period exponential moving average on here in green. And so as I look at this chart, an SSO daily chart, I can see, you know, the Bollinger does a pretty good job of picking where moves are going to come, but sometimes it doesn't. If you look at that Keltner, it does a very good job of kind of using it both for support and resistance, so it gives me an implied trading range on a leveraged ETF. And if you look at a lot of the key price pivots, they happen right around the 20-period EMA. Here, a lot of congestion around there. So let's move to another chart and look at just the Bollinger and the Keltner to get to. So I'm not going to look at the midline quite yet. And we've used both at Right Angle Trading, and we've taught both in courses, and we've used both. Betty is a big believer in Bollinger Bands. I like John Bollinger's work. I think they do a great job. But we actually prefer, for the leveraged ETFs, the Keltner channel to assess because we think it does a slightly better job of recognizing where support levels, you know, where we can expect retracements when combined with certain moving averages that I'll get into in a sec, and a better job of recognizing exit points on overextended moves on leveraged ETFs. So let's look at the same chart now, an SSO daily, double leveraged S&P 500 ETF. Sorry, I had to look at a message there real quick. Let's look at with 3 moving averages on it. The green is a 20-period exponential, the blue is a 50-period exponential, and the red is a 100-period exponential. And virtually every price pivot point occurs between, you know, major price pivot point in the trend occurs somewhere between the 20 and 50-period moving exponential. That becomes a very strong area of support and resistance in any trend. You know, resistance in a downtrend and support in an uptrend. And a good place to kind of maybe throw an initial stop out, you know, if you're in it for a longer term investment, is that 100-period EMA, because the S&P 500 double leveraged ETF never went below the 100 EMA for this period of actually it was for several years. We're looking at about a year here. And then these key pivots, you could almost just trade in and out, buying it every time it touched the 50, and you know, kind of using the 20 as a stop. So to protect profit. So let's just remember that as we move forward with what I'm going to show you. Let's look at another more volatile market and see if this holds true. Because anytime you're doing back testing, if you look at one market, you look at 6 months of data, it's not doing you any good. We like to look at 10 years of data, 5 to 10 years of data on a multitude of markets and see if it works. And let's see if the same principles hold true on a TNA, now a more volatile market that we know, as we saw earlier. The triple average, the Russell 2000, inherently more volatile than the S&P 500. Yeah, I'll get back to the Keltner and the BBs again, or the Keltner. The BBs was just out of the box, whatever the standard settings are, because we actually really don't use it. I'll get into the Keltner settings in a second in a little bit more detail. Once again, where do we see support and resistance areas? Right around that 50-period EMA. When the trend is going faster, right around the 20-period EMA, and rarely does it ever go below that 100-period EMA. So now I've kind of proven that on two different leveraged ETFs, on a less volatile market and a higher volatile market, we know that these EMAs are going to give us a pretty good area, even taking into account a retracement where it's going to go a lot farther than the Russell 2000. So if the Russell 2000 goes up 10% and retraces 4%, the TNA, is going to go up more than 30%, and then it's going to retrace more than 12% because of the decay in the options over those period of days or weeks of that retracement. And we know that. We've seen that. I've already proven that. Nonetheless, the 50-period EMA, because it's going to be more heavily weighting the most recent days in the trading, in a 20-period EMA and a 100-period EMA, the EMAs, because of the way they weight, putting much heavier weighting on the most recent days, is going to react more quickly to that decay in leverage. So these are tools that we like to use. Again, let's look at a TNA on an hourly chart for shorter term swing trading, meaning, taking a trade either for the day or for a couple of days, and look how many pivots happen right at the 20-period EMA, price pivots. And what I tend to do, 50, 20, 20, 20. Okay, so let's just think for a second. We're talking about risk management. If I get into a bull position down here and I want to trail my position, where's a good place in a fast trend to trail? Well, right under the 20-period EMA is a very good place to trail on a bull move. When I'm getting in, where's a good place to put my initial stop? Probably under the 100-period EMA. I get in here right at the 50. My initial stop goes right under the 100, and now I can trail right under the 20 EMA, and you have to leave a little room. You can't stick it right at the 20, but look at how it allowed, and that's exactly what we did on this move. This, incidentally, on a 60-minute chart is the same move I looked at earlier on that we looked at on the daily charts, where the TNA went up 20% versus the 18% in the IWM. Again, you just look through where price pivots occur when it's coming back down. When do we get a little short-term trend reversal? And again, right around the 20-50 EMA, when it goes back up, comes in right off that 20 EMA as a price pivot, and coming down here when the market reversed back down, again, you can see all the price pivots occurring between the 20-period and the 50-period EMA. So these are very responsive indicators that can help us as traders control our risk and take care of our profit when we're in a winning position. So I want to look at some specific, and I'm going to show you a losing trade too. I never do a webinar without showing some losing trades. This is that same trade again off of the daily chart, and I'm going to show you exactly how we took it for our end-of-day alerts, exactly how we teach it in our courses to manage this trade. And now I'm going to get into the Keltner channel. So the Keltner channel settings, they're called different things in different charting platforms. I use TradeStation, and when it comes out of it's called the number of ATRs is the setting that we change. The number of your average true range, the outer bands of the Keltner. It's whatever is controlling the space, the width, or the height of the outer band of the Keltner. It's not the offset, because that offsets to the bars. I forget what it's called. in like Thinkorswim. Different platforms call it different things. When it comes out of the box, when you first put it on your chart at default settings, that default number is almost always 1.5. Sometimes it's 1.25, but most of the time it's 1.5. We changed that to 2.5. So we got a trade signal to go long down here on February 6th on this green candle. And look where this price pivot occurred. This is, for me, as a trader, this is a dream setup. And our momentum and trend indicators gave us a signal to go long based on divergences. But as I look at other tools, this is a dream setup for me for a triple leveraged ETF. It's coming right off the 100 period EMA. It's been outside of the Keltner channel. And if you think back at that 2.5 setting to the daily charts we looked at, very rarely did it stay outside the Keltner on daily charts more than 2 or 3 days. Very rarely. And here we've been outside of it for 4 days. So when I'm considering my reward to risk, I expect to move back up. Now let's think back, because it's all about calculating that reward to risk. When we got to move back up on all of our earlier charts, we always came back into the 20 period EMA, right? That was always at least the 20 period EMA became my price pivot point. So even if I'm fighting a counter trend move here and we have a new downtrend, I expect it to at least first bounce up into the 20 period EMA. In reality, I expect it to run all the way back to the other side of the Keltner channel. That's my implied trading range. I expect almost no downside here. So I get long right here, and I can place my stop right here, which is at about 6% on a triple leveraged ETF. That's the equivalent on the IWM or the Russell 2000 of a 2% stop. And I expect to be in this trade no longer than 2 to 3 weeks at the most, because it's triple leveraged ETF, and I want to lock my profit before the decay in leverage starts eroding my profit potential versus the underlying index. And when I look at a 60-minute chart, actually I don't have it here, so it was back a little farther, but it was, I could look at where my 100 EMA was on a 60 chart. It was like right down here at the bottom, so I could place my stop slightly under that, 6% trade going in. So now let's talk about managing the trade. The next day, it comes up, and it's running up, it's going my direction. There's volatility. After that first day up, I'm going to slide my stop up so it's just slightly under the daily 100 EMA. So now I've cut my risk in half. Now I'm only looking at a 3% loss if this thing tanks against me on the Russell 2000. In a triple leveraged ETF for the Russell 2000, if you're holding overnight with a 3% stop, that's a dream come true. It's a volatile market. Next day it goes up the next day and touches the 20 period EMA. So block out everything to the right. We don't know what's going to happen right here where it touches that green indicator. It could roll right back down, right? We have the 50 EMA there as well. Could roll right back down, and we could be in a downtrend, so I'm getting my stop to break even. It's gone the minimum that I expected it to go based on what we looked at and studied as far as how far these moves were going. So now I want to remove risk from the trade setup. And I've still got enough space that even if it gaps against me, it's not going to gap past my stop. So I've got it break even plus a few cents to cover my commission. So now I can sleep good at night. Come up the next day, it's still fighting this area where we expect resistance. It's doing exactly what we expect it to do. Sure enough, now my stop is still down here. The next morning it opens way down here under the 20 EMA, and I'm like, well, I'm glad I have my stop at break even, but it runs up all day, and this is why I didn't want to move my stop too fast. A pitfall all of us get into, I think all of us as traders, is when a trade's going our direction is to be a little too aggressive with our stop, and I'm going to show you why in a minute on another trade. Sometimes, you got to give it room to run, right? Especially in these triple leveraged ETFs because they come down pretty fast. So now it moves up, it recaptures the 20 and the 50 period EMA. It's very bullish right up here. I'm going to move my stop up well into profit right under this daily pivot on this big green candle. So now my stop is here As it starts running, comes back down, kind of comes into back test the 20-period EMA. I'm going to move my stop when this is happening slightly under the 20-period EMA to leave a little bit room for a poke in case it just pokes through there for an hour or two. I don't want to get taken out of my trade. And now as it breaks up, and as soon as it clears that upper band of the Keltner channel, I'm just trailing my stop up with the 20-period EMA. Remember that chart we looked at a minute ago. Once you ran a strong move, you can just run your stop up along with the 20-period EMA. It's gotten outside the Keltner channel. It stays out for a few days. And again, I expect it to come back down now. Rarely did we ever see it stay outside the Keltner and close outside more than 3 or 4 days when we looked at that year worth of data. So I expect it to come back down to at least the 20-period EMA, which is exactly what happens. And I got a signal, a divergence signal to exit the trade. Didn't get a short signal, but I at least got out of the trade. Our clients got out of the trade. 20% gain. You're in it for 2 weeks. You did better than the Russell 2000. Your risk was removed from the trade in 3 days, and it did exactly what we expected to do every step of the way based on these indicators. And again, this is a dream setup because of where we're getting into the trade. Part of risk management is not just the indicators you're using or whether it's fundamental analysis, but look at something to tell you, am I getting in no man's land, or am I getting in at a really good place where when I go into this trade, I know that the reward to risk ratio is working as much in my favor as possible. We like to trade with a minimum of a 2.5 reward to risk, preferably 3 to 1. We made 20% on this trade with an initial stop at 6%, so it returned over 3 times what our initial risk was. That's a perfect trade to me in a triple leveraged ETF. Meanwhile, I kept as much profit as possible up here on this red candle when we got out. I knew it wasn't going to stay outside of this Keltner much longer. I wish I could time them all that perfectly. Got lucky on this one, but it did do what we expected to do. Excuse me. All right, now let's look at a losing trade, because I always like to look at losing trades. I like to analyze losing trades. What could I have done better? What can I learn from this trade? This is the DXD, a bear ETF. Any of us who have tried to short the market over the last 4 years know not many of them have worked out, right? Unless you got lucky. We've been in a strong bull market. We have been heavily favoring bull trades. If it kind of looks like a bull setup, take it. But the DXD had made a big move up, and it came back down. It didn't stop at the 20 and 50, so the DXD is the double leveraged bear ETF for the Dow Jones Industrial Average. We got a trade set up here for our end-of-day ETF alerts. It was kind of what we would call a new trend continuation trade. It was possibly pivoting back up to shoot up higher. It was kind of down towards the lower half of the Keltner, but not really. I would have liked to have seen it pivot right at the 50-period EMA, right? That would have been a great entry for a trade, but it didn't give us a setup there. It kind of came down. But, when you compare it to this TNA trade where I'm taking it right off the 100 EMA and the Keltner channel, well, I already know I'm counter trend because my 100-period EMA is way up here and I'm under it. So I know it's a counter trend trade, a higher risk trade. It didn't even make it down outside the Keltner when I got the trade signal, so I took the trade in no man's land. Now, as a trader, a technical trader, when I get a signal, I take it. It's not my favorite. So from a risk management standpoint, I can size my position down and only take it with a half position. It's a short position. We're in a bull market. I know that shorts haven't done very well over the last couple of years. So scale down my position, control my risk when I go in. I might have taken it with full position if I had gotten in way down here. So I get in with roughly a 4% stop. I'm going to set my stop a little bit under the lower band of the Keltner channel. There aren't any other EMAs to use. And, like I said on that TNA trade, we expected to go at least right up into the 20-50 period EMA. This trade didn't even do that. So my initial reward potential as far as when I could move my stop, I wasn't even going to be able to get it into break even unless it really popped way up here. Trade kind of bleeds against us for a week and eventually stop out with 4% loss. But my point being, based on using these indicators as kind of a method of helping us assess risk management, I took this trade in no man's land. And I knew when I went into that trade I'm taking this trade in no man's land. It's not, at the full range I would have liked to have seen it. So why don't I scale back on my position sizing and reduce my initial risk? And we're coming off this huge winner in the TNA at the same time, so I don't want to give all that back. So you can kind of see the difference there. So I want to look at the same tools now on a 5-minute chart. Kind of a day, somebody asked the settings for the Keltner again. The Keltner channel setting is 2.5. That would normally come out of the box at 1.5. So this is a TNA 5-minute chart, taking a day trade, strictly a day trade. You can see on a 5-minute chart, price pivots occur around that 20-period EMA all the time. But when it breaks out of that 2.5 Keltner, especially something like the TNA, it will happen on the UPRO and these triple leverage, that's actually going to become a support area. So let's walk through trade management on this trade. And again, I want to look for 3-to-1, right? So I get the trade off the 5-minute chart. I get a trend continuation from the prior day setup to get in long right here on this candle. I also have a 1.25 Keltner on here because you're going to see that's going to be another area of kind of support and resistance and congestion at times. You can see it here. You can see it here after we get into the trade. So we get into the trade here. It's just above the 20-period EMA. So I'm going to use my initial stop is going to be right under these dotted yellow lines where this first line is. My initial stop is less than 1%. So my initial stop on a triple leverage ETF for a day trade, less than 1%, which is great. That's what I want. So I get in the trade. I'm in it for about 20 minutes. It kind of comes up here and bounces long, exactly as I expect it to do at this 1.25 Keltner channel. Comes back down and price pivots off the 20-period EMA. Right there, I'm going to move my stop up a little bit under the 20-period EMA. When I see it come back down into it and turn up, I'm moving my stop up. It's just under break even. I've got, maybe 10 cents of risk on a triple leveraged ETF at 62 bucks. It pops back up in our direction. Now I'm just going to trail it up with this 20-period EMA. As long as it stays outside the Keltner, I'm actually going to move it up to this other dotted line. Because if it comes back down, I don't want it to come back down into the 20-period EMA. I want it, so this second dotted line is another Keltner at 1.25. As long as it's staying outside of that 2.5 Keltner, I'm staying with this trade. The second it comes back in, second a candle closes back inside of it, I'm out of the trade. And I expect it to come back in and consolidate around the 20-period EMA. I didn't get another signal to get back into the trade. If I had, I would have taken it. I would have expected it to come back into the 20, jump back in for hopefully another move up. I didn't, and it flatlined the rest of the day. But ended up with about a 3% return on the trade, less than a 1% initial risk, trading at that 3-to-1 ratio. I want to look at a trade that I'm in right now, all of our clients are in right now on the daily charts, which is a triple leveraged UPRO trade where we got a long signal about a month ago. And, we're in summer trading, right? We're in choppy trading. The two settings again on the Keltner, 2.5 for the broader one and 1.25 for the inner one. So the dotted yellow, it's probably hard to see on your monitors, is 1.25, 2.5 on the outer, and that's what is the number of ATRs or what comes out of the box. The default setting of 1.5 changes to 2.5 and 1.25 for the second one. And you can turn the midline off. I don't really use the midline at all. I have it on here in gray. It's just a 20-period simple moving average is all that the midline of the Keltner is. So we get long on the UPRO here, and our initial stop is right down here. And how important is that where your initial stop is? If you had thought, I'm going to set it right under this price pivot right here, you would have just gotten barely by a few pennies taken out of this trade a few days later. And if you didn't get a signal to get back in, you're sitting on the sidelines for this move up. So how important is your initial stop? I was actually in here this morning and I saw another presenter show the exact same thing. Where do you place that initial stop? I took it just over this trade, just over the 20-period EMA. So I'm going to set my initial stop right under that 1.25 Keltner. Sure enough, look what happens. Where does it come down to? Almost that 1.25 Keltner. Once it pivots back up, I'm moving my stop up, reducing risk. And once it gets up over that next 1.25 towards the Keltner, now I'm using the 20 EMA and I'm guiding the trades. Once it breaks up and over the Keltner, again, we don't expect it to stay out for more than 3 or 4 days, right? It should come back in. Now I'm using this 1.25. And this is how we're managing the stop for our clients right now on our end of day alerts. So it's doing exactly what I expect it to do. I hear the perma bears are out there yelling, this is it. They've said it 20 times over the last 2 years. This is it. I don't care if this is it. I have no emotional attachment to whether the market goes up and down. All I care about is the market doing what I expect it to do right now? I'm long. I've been long for a month. I've got my stop well up into profit, and it's doing exactly what I expect it to do. I expect it to come back inside of the Keltner and bounce back up without going below that 1.25 Keltner. So I expect it to come back in the 2.5 and go back up without coming back inside the 1.25. And every day I'm tweaking this little white line up just under that 1.25. If I'm wrong now, it doesn't matter. If the market rolls back over and comes all the way down to the lower end of the Keltner or the 20-period EMA, I'm going to get stopped out at profit, and I'm going to get stopped out with at least 2 times my initial risk based on where my stop is today. I'm going to, I expect summer Fridays. Here's an interesting statistic. God, I wish I could remember where I found this. It was about 2 years ago. I read a guy, he had tracked 40 years of summer Fridays. I always thought summer Fridays would be the worst trading days of the year. June, July, and August, Fridays, 85% of the time over the past 40 years, the market has gone up. If I told you, here's a trading methodology that you're going to win on 85% of the time, you'd tell me I was nuts, right? 85% of the time over a 40-year period on summer Fridays, the market goes up. I thought that was just a mind-boggling statistic. So based on these indicators, the market has done exactly what I expected it would do. It's coming back in. It may trail down a little bit more. I don't want it to go below that 1.25. Regardless of what the market does tomorrow, my stop is going up a little higher, just under that 1.25 Keltner channel, wherever it is at the open tomorrow morning. And then, I expect it to turn back up for another try, staying outside the Keltner to do a little price pivot here. That's what I expect, and I'm just going to keep moving that stop up. The next time it goes up and outside the Keltner, the stop's going to go up just under the 2.5 Keltner, and I'll trail it from there. If I come back down and get stopped out tomorrow, if I'm wrong on what the market does, I don't care. I've already got 2 times, about 2.5 times my initial risk on the trade, and our clients do too, and then I'll wait for my next trade setup to see what happens. That, my friends, brings us to the Q&A. Why not get out once it gets out of the top channel? Bruce, that's actually a good question. Because just by trial and error and watching it over many years of using this type of a setup, once it goes out, let me scroll back to another chart. The SSO daily. It tends to kind of grind along up there in a strong move. See it come back in and then pivot up again. And if it doesn't break out that second time, then we'll get out of the trade. So looking at this daily chart right now on the UPRO, if it doesn't, not ready for that. If it doesn't get back up, if the market turns back up and doesn't get out of there, we're going to get out of that trade. Then we're going to get out of that trade. Right now, this is just kind of a matter of opinion. I think the market wants to see 2,000, and I think summer's a good time for it to do it because the volume's lighter. It's easier for big money to run it up. Do you ever use options for leverage instead of leverage ETF? I don't. I'm not an options trader. We have clients that do. They take our signals and they trade. What we recommend is we're never in a trade more than 4 to 5 weeks on our end of day signals. So like our end of day clients, if you're trading the S&P 500, take a SPY option, buy a next month out in the money call. Or if we got a short signal, a next month out in the money put, not out of the money, because we don't want that premium to work against them. If the trade goes against us, it's going to throw off their risk to reward. So go in the money so that you've already reduced some of that premium. If it goes in our direction, you're still going to get a lot of premium on the trade that will probably equal the leverage of the ETFs. Okay, spreads on leveraged ETFs. Mike, it really depends what you're talking about. The TNA and TZA trade wonderful volume day in and day out. Triple leverage Russell 2000. We're very selective on what we trade. The emerging markets, the Russell 2000, S&P 500, Dow, NASDAQ. We don't even like the triples on the Dow. I hate the triples on the Dow because of exactly what you're talking about, spreads. I've seen the Dow triple leveraged ETFs one day trade 2 million and the next day trade 150,000. I don't want to trade anything like that. So we don't recommend that clients trade the triple leveraged Dow ETFs. They're too inconsistent in their volume. When you're talking about the UPRO and the XPXU, the volume is there every day. The spreads on this at 111 bucks today, the spreads were running at about 3 to 4 cents most of the day. Excuse me. Running at about 3 to 4% most of the day. I'm sorry, my allergies are just going crazy right now out here in Southern California. 3 to 4% on $111. On the TNA TZA, they're typically at a penny spread. They are so liquid. And you can hit them with a market order and not budge the bid and ask with a large number of shares. So that's why one of our criteria for the ETFs, as I said early in the presentation, is the liquidity of the ETF itself. When you move into some of these, there are commodity ETFs, the AGQ ZSL that we love, the double leveraged silver ETFs. Wonderful liquidity. You're not going to budge the bid and ask. You can get into some of these, like agriculture or some of the UCO, SCO, double leveraged oil ETFs can have wonderful liquidity. But there are other ETFs out there that one day they're going to trade 1 million shares, and the next day they're going to trade 100,000, and you're going to see 20 and 30 cent spreads. And when you combine leverage potentially working against you with a wide spread, that's not something we want to trade. Stick to the good, there's plenty of good ones out there. We list them in our ETF course. You can go to ETF Stock Encyclopedia, and they list every ETF under the sun. But like we say, we want to see it trade for a year and put up that, put up a volume chart like we looked at earlier and see, does it have consistent liquidity? Watch it trade for a day. What are the spreads on it? Is that something I'm comfortable trading? You can get in and out of the UPRO SPXU, the TNA TZA, AGQ ZSL, UCO SCO, DGP Gold Double. In and out of those trades all day. No, trend lines, Don. Okay, I'm back. Don, trend lines can be a little bit unreliable in the triple leveraged ETFs because of the leverage. They tend to really overshoot things. I've never had, I've used trend lines for years trading futures. In the triple leveraged ETFs, they tend to not be as effective. You always want something that is not fixed at a percentage, but that is constantly moving with the leverage, changing day in and day out, and that's why we've kind of settled on things like Keltner channel and exponential moving averages. They're going to react to what's going on at at that day. Oh, Spurs up 55-36 at halftime. Woohoo! Go Spurs! I love the Spurs. I really want to see Duncan and Ginobili and Parker win one more. Anyway, so let me tell you what we have going on at Right Angle Trading, and I'll tell you two things. First of all, you can go to our website, get my email address. It's Brad Powell at Right Angle Trading. We're not doing trials now. I'm always happy to offer somebody free trials to our end-of-day ETF service for a month. We just don't do it during the summer because we know we're not going to get that. It's a waste of your time. It's a waste of my time. During the summer, you're not going to get as many trades. when we get in a trade, it's going to be like this UPRO trade. We're just hanging out. You know, we've been in it for a month. That's really all we've done over the last month. Get long, get in something long, stay in it. You know, trading conditions, volume has been exceptionally low over the last 3 to 4 weeks, surprisingly low for this time of year. It looks more like late July, early August volume than it does June volume. And I'm kind of surprised. I think we're going to see a very stagnant summer. But, you know, bookmark our website if you're interested in our end-of-day ETF alerts. When we get into the end of summer, mid-August, happy to give anybody a 30-day trial. If you're really into trading ETFs and want to learn a new methodology, as well as get our alerts through the end of the year, we have what we call our live trading package. I'm not going to harp it. I'll just share I'm not going to harp on it. It's you know, our course and mentoring. We do monthly trading webinars. We do periodic live trading days. Our end of day alerts through the end of the year, and it's for $4.95. And I'll just share the link with you on that. And we actually already closed it. We do it going into every summer, but just because I was doing this thing, I thought I'd reopen it and share that with everybody. But you can, you know, if you'd like to get a free trial to our ETF service, please, you know, just wait. I just hate to get people on trials during the summer months. I'm going to take vacation. Betty's taking vacation. We all know the market's really slow right now. You know, wait until mid-August. Shoot me an email, and I'll get you on the alerts. You can sign up for our alert list, you know, at our website, rightangletrading.com, or shoot me an email in August, bradpowell@rightangletrading.com, and we'll get you signed up for a 30-day free trial, 1-month free trial of our end-of-day alerts as it gets more active. And we generally get a lot of signals coming out of summer in late August, jump into a lot of positions across a lot of markets. So it's kind of a good time to get into it. Does TQQ meet our spread? Only in the last 6 months, Mike, has the triple leveraged NASDAQ 100 ETFs met our volume criteria and kind of consistent liquidity. I would say in about the last 6 months to a year, yes, we've just started kind of recommending them to clients. The T triple Qs and the S triple Qs, they finally have kind of gotten that consistent spread. Bruce, we're going to be relaunching the intraday service at the end of the summer, and we'll have trials for that as well. We're not doing it right now because it's just trading conditions are so slow, and we're actually kind of incorporating a new strategy we've developed, and we're going to combine kind of the old strategy and the new strategy for our intraday alerts. So just touch base with me at the end of the summer for that, and we'll be happy, you know, to get you on a trial for that. We just didn't want to do it during the summer, and also we were having trouble with the text service. There were a lot of non-deliveries. We want to try a couple of new services with a few clients. There were just a lot of reasons to just kind of temporarily suspend it, get it revamped, get a more reliable text service. You know, I was getting really mad at the amount of money we were paying a month for our text service to have it not get delivered. You know, there's free services that would be more reliable. The leveraged commodity ETFs, Mike, you know, stick to the biggies, stick to oil, gold, silver. I love the AGQ ZSL pair, silver double leveraged ETFs. I think they're just about the best trading instruments out there in the ETF market. Tight spreads, great price movement. They've been a little slow lately, but that's not uncommon. It's just because silver gets slow over the summer. They'll come out and get very volatile, you know, late in the summer and start moving. You know, the oil ETFs, the UCO, SCO, we like to trade. I tend to not like any of the agriculture ETFs because they're so inconsistent in liquidity. You know, those are kind of the biggies. Gold, silver, and oil, you know, those are the big ones that are pretty good for trading. I'm starting to look into some of the currency ETFs as some volume has started to pick up. I think because we've been in somewhat of a stagnant, predictable pattern market. Chop, chop, chop for 2 weeks, make a move up. Chop, chop, chop for 2 weeks. I think people are looking for other things to trade in the ETF market. I think the next one over the next year to two will be some of the currency ETFs. So I'm kind of watching the Euro ETF, some of the other ETFs starting to do some research. So that that wraps it up. Wraps it up for me. I will turn it back over to the gang at TradingPub. Thank you very much, Frank. Sorry about a few of the connection. I seem to be having weird internet problems. Welcome to Los Angeles. I always love to say Los Angeles, our public service is slightly better than a third world country. So, but thank you so much to all of the team at TradingPub for having me back. I really appreciate it, and it's always a joy to work with you guys. What a just tremendous organization and group of people you guys have.
Well, we're delighted to have you, Brad. And once again, it's kind of a tough position to be batting cleanup, but we had a terrific group of folks hang on to us throughout this entire session. And once again, I think the ideas and the concepts that you shared with us with regard to trading ETF was a great way to wind up the evening. And I also appreciate your candor and your views about some of the challenges with trading ETFs and positions like that over the summer months. So, you know, I just want to remind everyone that we did publish a link here for the special that Brad has put up, and it's at rightangletrading.com. Looks like a heck of a value for the kind of services that you're going to deliver. I'm particularly interested anytime that you can get high quality alerts for opportunities that you don't have to babysit. Once again, these are swing trade positions, and I believe you said that 3 to 5 weeks was a typical duration for a trade that you made, so that could be very attractive, in particularly for people that have to work for a living and can't watch the markets during the day. So once again, do appreciate you, and on top of that, I just want to...
I'm just going to share my email.
Yeah, go ahead.
A couple of people are asking me, Brad, how
Yes, please. If you could post that there, that'd be wonderful, Brad.
There you go. My email.
Perfect.
Certainly.
And there you go. And so I just want to just kind of wrap things up once again by thanking everybody for coming to the June edition of the TradingPub Trade-A-Thon. We've had a tremendous day, and I just want to take my hat off to all of you that have been here. Looking at where you're from, we had traders from as far away as Australia and Asia. We had South Africa, the Middle East, several countries throughout Europe and South America, Mexico, Canada, and of course the United States. And once again, just a tremendous turnout. I also, though they're not with us, I want to thank Rich Riley from Trader Kingdom, who kicked things off this morning, Paul Lang with Pristine, Chris Zavorchik from Winner's Edge Trading, Elon Meyer from Cannon Trading, Cecil Robles from Forex AIR, Joseph Cusick from MoneyBlock, Brian D'Amico from VestorVest, Andrew Keene from Keene on the Market, David Osmond from Metastock, Tom Busby from DTI, David Truffleman and Aaron Eitenbrook from I-10 Research, and of course, Brad Powell from Right Angle Trading. And once again, to all of you, thank you for coming. And I'll answer the question that's come up here again. Yes, all of these sessions have been recorded, and we're going to slice and dice them up into the 13 components, and we're going to go ahead and create a link for that, and we're going to send you all a follow-up email with that information. So from that perspective, you'll be able to take a look and watch and refresh yourself with all of the presentations that we had today. So once again, thank you so much for coming. Our next Trade-A-Thon will be on July 10th. And based on the quality of the speakers that we had today, I think we're going to be a little hard-pressed to come up with the kind of lineup. But we've got some good folks in the wings and a lot of people that are excited to share some new ideas. So from that perspective, once again, take care, everyone. Have a pleasant evening. Be safe. And we'll see you next time at the pub. Bye-bye.